Welcome to the MoneyScope podcast, shining a light deep inside personal finance for Canadian professionals. We are hosted by me, Benjamin Felix, portfolio manager and head of research at PWL Capital, and Dr. Mark Soth, aka the Looney Doctor. All right, so this is our fourth case conference supplemental episode. We hope you're finding these useful as a complement to the main episodes. These cases are based on common scenarios that often lead people to make poor decisions with their investments. The idea is that you'll consider how the situations apply to you. Our guidance to the hypothetical scenarios are not specific advice, but hopefully you can relate to aspects of them and use them in your own thinking with yourself or with your advisor.
Great, yeah. So we did spend a lot of time in the main episode talking about different registered investment accounts. And, despite all of their potential advantages, people can get hung up on some of the dilemmas that go with making the most out of them because they are complicated. So we hope to hit up on a few common ones today. And with that, we're going to get started right into our first case, which is about the RRSP versus TFSA decision.
Oh yeah, this is such a good one and so important and so poorly understood. So we hope people come away from this with a lot of clarity. Okay, so we have an employee at a technology company and they've got a $150,000 salary, but a large part of their expected compensation is in the form of RSUs, restricted share units. So their employer grants them RSUs when they start working, but it takes a year for them to vest. So that means they don't actually have access to them until they vest. The RSUs are not included in their income until they vest, and then once they do vest, each vesting amount is fully included in their taxable income. So unless the company's share price tanks, because usually you're granted a number of RSUs based on the share price at the time that they're granted. So it's like a number of shares that you'll receive in the future. But that means that if the price goes down, your number of shares stays the same and the value that you get when they vest goes down. So unless the share price tanks, which of course is always a possibility, especially in tech, they expect their total taxable income to be over $500,000 next year.
Yeah, and just so before the eyes glaze over of anybody who's not part of a tax firm, this is actually, even though it does deal with the special case of these RSUs, this is actually a fundamental issue that's going to apply to anyone who has a high income that's still below the top tax bracket, especially if they have a predictable, massive taxable lump of income bumping them up in an incoming year. And that can apply to many situations. It could be an early physician moving from residency to their early practice or building up their practice, and a corporate business owner again, investing time in their business, and suddenly they can see that it's going to start to really take off. Or even anybody who just knows they're going to need to take a big chunk of money out of their corporation for personal consumption over the next couple of years, that may bump up taxable income. So there's lots of ways this can apply to anyone.
Yeah, exactly. So it's where we use the RSUs as an example because it's one way that this could happen, but it's one of many, like you said, Mark. Yeah. So it is a pretty common issue. Now, we all have limited RRSP room because you get it based on a percentage of your earned income each year, but you can only get it for a limited number of years and up to a cap every year. So it's really important to get the most out of each contribution or out of each deduction, I guess is maybe a better way to say that, because you can make a contribution and then deduct it later. So in our example, the relevant tax bracket in Ontario in 2023 is the over $106,717 up to $150,000 bracket, which is taxed at a combined rate, provincial and federal, of 43.41%. So this means that in this case, each dollar of RRSP deduction reduces your current year taxes by 43 cents by lowering your taxable income. So in this case, because we know that there's going to be that big jump in tax brackets, and there's limited savings, right? So this person's making $150,000. We don't know what their lifestyle expenses are. We didn't get into that, but they likely have limited savings. It's probably going to make sense for them to use their TFSA room, if it's available, for now, and then use the RRSP contribution and deduction next year. It is possible to use the RRSP contribution now and carry the deduction forward, but we don't want to carry it forward too far into the future because there's a sort of implicit cost to doing so. So given the choice between using the TFSA and using the RRSP contribution this year and carrying the deduction forward to the future, the TFSA is going to be more attractive in that case. And then next year, when taxable income is actually higher and there's going to be more liquidity from the RSUs vesting, the RSP is more likely to make sense.
Yeah, and I think that cost of waiting far into the future is important too. This is something that, 1 or 2 years at a time, not where you have a bunch of unused RRSP room for 20 years from now. I mean, that's way too long. You have no idea what's going to happen.
Yeah, definitely.
All right, great. So I think that's a very common case that comes up, especially for physicians starting out or people that are working with firms that are going to give them these RSUs. But the next case is also going to be really common, and this is about escaping the group RESP. So this case actually describes a number of close friends of mine. It's very common. And it's funny because I was actually discussing it a bit with my wife as we were writing the case, and contrary to the usual response of kind of nodding and nodding off, she actually got excited too because she knows a whole bunch of people who are again in this kind of situation. And it's one that often comes up when people have learned more about investing and they realize that maybe they may not have done the best thing, and how can they adjust course. So the couple in this case they're not physicians, but they're high-income employees. They have a son who's now a few years old. And when he was born, they got the marketing push from a group RESP and they signed on to that plan. And over the first 4 years, they contributed about $2,500 a year. But then now, after doing some research, they want to use a self-directed individual RESP instead of the group RESP. And, they're in a good situation. They have enough cash flow that they could contribute more each year. They just haven't, because that was just part of the contract and they didn't really understand how it all worked. They could even contribute up to the lifetime maximum of $50,000. So they have those resources to actually do something different if they want to. But what would be their options and the likely consequences of that?
Yeah, so these are really complex plans. It's important to understand how they work. You buy units in the group plan, and those units entitle you to a portion of the group's future educational assistance payments. Now, there are typically going to be large sales charges up front, which get at least partially recouped if you stay in the plan. So that's really important, because if you buy units initially, there will be large sales charges that can actually eat up all of your contributions. So if you try and exit the plan early on, you might get nothing back. There may be nothing for you. So you end up being on the hook for those initial upfront costs. And your contributions to the plan going forward usually go toward paying the sales charges off before any money actually gets invested, which is it's kind of crazy to think about. So you're basically you put money into this plan, and for the first little while, you're just paying off sales charges.
Yeah, and you'd mentioned too that actually counts for getting the grants too. So if you're putting $2,500 in, but $500 of that goes to paying fees, then really it's $2,000 for calculating the grant, not $2,500.
Yeah. There's some detail like that where to get the maximum grants, you actually have to be contributing more than the normal $2,500 that has to go in. So yeah, that's another crazy thing about these. So the other unique aspect is that if you stay for the full duration of the contract, you actually get to participate in some of the earnings that people who left early gave up, which is also crazy. So these things they're kind of predatory, right? Where if you leave, you kind of get screwed. But if you stay, you kind of benefit from the people who got screwed.
And you don't know how that balance is going to go.
Yeah, true. Okay, so with that as a setup, what to do when you realize that you're in one of these plans is going to depend on where you are in the life of the plan. So you've had this realization that hey, maybe I've learned something, that maybe these group RESP plans are not so good, but I'm in this contract. What do I do? If you're within the first 60 days of the contract, you can typically get out without any penalties. So if this just happened, as it tends to, like right when you're in the hospital, you've just had a baby, they're kind of predatory that way. So you've just enrolled in the plan, within 60 days, you can probably get out. So that's the best case scenario. If you're past that and within the first couple of years, you can run the numbers on the trade-offs between the cost of exiting the group plan and the higher expected returns of a self-managed RESP account. Because there's going to be a cost to exiting, but then if you set up a self-directed RESP or an RESP with a financial advisor, the costs are typically going to be much lower, and the expected returns on the investments available to you are typically going to be much higher. That depends a little bit on your risk tolerance and stuff like that, but it's still a scenario that can be run. The answer there is going to depend on your assumptions, like expected returns, as I just mentioned. But if they're a lot of years ahead in the plan, so this is, again, if you're early on in the group plan, there's a good chance it's going to make sense to exit and eat the penalty costs. If you're more than midway through the contract, this is where it starts to get really tricky, because later on in these plans, you're typically going to get a large portion, often up to 50% of your fees, rebated. And then you may also get that windfall that we talked about earlier from the foregone returns from the other contract holders who have decided to leave the plan early. And you're also going to have fewer years left for higher expected returns to make up the difference in that case. So if you're much later in the plan, you can still run the numbers, of course, but there's a good chance that if you're kind of more than halfway through the contract, that it's going to make sense to stick it out.
Yeah, so sticking with the existing group plan or exiting depends on how far along you are into it. However, if you aren't obligated to make further contributions, could you open a second RESP and then take advantage of some of that extra tax-sheltered room up to the $50,000 lifetime limit? Even though you may or may not get extra grant money depending on how much you are obligated to put into that group RESP plan, could you do that as a different way of not making even more money into that?
Yeah, it's definitely possible. I think it's really important to understand the group RESP contract that you're in. I mean, these contracts are just bricks of text, and it's a contract, so you've got to read it and understand the implications of doing different things.
Yeah, we read a few. We read a few of those. Preparing me for this.
Not the most exciting reads.
No.
Yeah. So they're set up so that you buy a number of units in the plan when you open it, and then that comes with the upfront sales charge we talked about. The sales charge is a fixed amount based on those initial units. It's spun as a sales charge per unit, decreasing as you purchase more, but it's really just a sunk cost, and it gets diluted as you contribute more money. You can usually decrease the ongoing contributions down to a minimum by reducing the number of units in your plan, but you're forfeiting your contributions on any growth on those units, your contributions and any growth on those units. If you opt to minimize your contributions by reducing your units, you've got to be sure to use their form to do that. You don't want to skip payments, because that can mean defaulting on the contract, which comes with big penalties. Mm-hmm. There's usually a fee for decreasing the contribution schedule. So anyway, you got to be really sure to read the fine print of the contract you're in. Or if you have a financial advisor, this is probably something that they can review the contract for you. I learned a lot about this by talking to a friend of mine who's just, for whatever reason, he's seen a lot of these. He spent a lot of time with clients who've come to him with these plans. So he's spent a ton of time reading the contracts, and he had a lot of interesting little nuanced details, a lot of which we're talking about here. But similar to exiting the plan entirely, minimizing your future contributions might be another avenue to avoid kind of continuing to throw good money after this bad contract. Once you've minimized or exited the plan, you can then open a separate self-directed RESP and invest using that. You still can't exceed the lifetime contribution limits, so you've got to check to make sure that you're on side with that. The Canada Education Savings Program has a 1-800 number that you can call. They pick up the phone. They're super responsive, and they give you the information. An interesting point is that the CESG grants are paid based on the date of transaction. So if you make your contribution to your self-directed RESP, you may be able to get more of the grants into it before the group plan uses them. But again, you've got to make sure that doing that doesn't violate the contract with the group RESP.
Yeah. Yeah, well, lots of nuances in there, but this is, big money we're talking about too for a lot of people. So it's worth exploring.
Yeah, definitely.
For sure. Yeah. And that brings us up to our third case. So this is another really common one that I see all the time. This is fear of the too big RRSP, retirement savings plan. It's an area where there's common pushback for people who are incorporated. So one of the common areas is that, they've got this, I see a lot of colleagues, they have this huge amount of unused RRSP contribution room. I mean, they've taken T4 income from their corporation over the years, so they have the room, they just haven't used it. And they could use it. They could pay themselves a T4 income bonus from their corporation to fill that unused room. And because it's considered a salary type of expense, it's a corporate expense, and there's no corporate tax to do that. The RRSP contribution is a personal deduction dollar for dollar, so there's no personal tax either. So this is actually essentially a tax-free shift of money from the corporation to an RRSP. There's no tax penalty for doing that. But they still haven't used it because their accountants told them that they should just keep everything in the corporation and let it all grow there and avoid using their RRSP even. And it's always kind of puzzled me, and I've tried to figure out why that is. I've heard two main arguments to kind of make that point. One is that you're eventually forced to take money out of an RRSP. It gets converted to an RIF, and then you have to take a little bit out each year. And the argument is, in contrast, if you have all your money in a corporation, well, you get to decide how much comes out each year. You don't have to take out a minimum each year. So when you turn before the age of 72, you have to start taking out a small percentage of an RRSP each year. For example, if you had $1 million RRIF at age 72, you would have to take out $54,000 that year. It's the percentage, and it's tied to the value of the account. And it slowly ramps up to 20% if you're still alive and there's money left over at the age of 95. I mean, the idea is to gradually take money out of this and not have it be huge when you die. That's the reasoning behind it. And that's good reasoning because you actually do need money to live on. So this whole notion that you're going to just leave your money in your RRSP, never touch it, and even when it's an RF, it doesn't make a lot of sense because you're actually going to need money to spend, and there's no point in dying with this huge pile of unspent money. That may not be a smart move on its own for many reasons. And the other side of that argument that I find a bit misleading is this argument that you can control the income coming out of a corporation. I mean, yes, you can. You can decide not to pay money into your corporation. However, eventually you will have to pay money to the other corporation, or you're paying tax on that upfront anyways. So the way corporate investing works, and we're going to talk more about this in our corporate investing episode, the passive income that's there gets taxed at a high rate upfront, pretty close to the highest personal tax rate. And some of that money gets refunded when you flow the money out of the corporation and then pay personal taxes on it. So yeah, you can decide not to do that, I guess, but then you've decided that you're just paying high taxes up front. So it's not really a decision to make. So whether it's a corporation or an RSP, you're eventually going to have to take the money out of it each year. So that argument I don't think makes a lot of sense to me, really. And the other thing I would say is that taking dividends out of your corporation, that those dividends get grossed up, which means they get multiplied by a factor of 1.15 for a small business or 1.38 for an eligible dividend. And that higher amount of income then gets applied against your personal tax rates, but it also results in OAS clawback. So taking money from an RRIF may not have as much OAS clawback as taking it from your corporation does. And this focus on this is all a big focus on tax deferral. That's what's underlying this argument. But I think the other part that's missed in that equation is, besides tax deferral, the RRSP also has tax sheltering too. So all of that investment income that you're growing in an RRSP, which you've essentially in this case shifted from your corporation, is shifted from an environment where it is actually taxed. Dividends, interest, and realized capital gains are all taxed in the year that you have that. Whereas in an RRSP, all of that's not taxed. Now, deferred capital gains in a corporation can be very, very tax efficient, but other income may not be. So I think the second argument used to grow too big of an RRSP and forced to take out a higher tax bracket can get you tangled up in these OAS clawbacks as well. And could be effectively a 15% tax increase. So that's the rate that it gets clawed back at. And, that may not affect everybody, but it's going to affect people that have a taxable income in the $87,000 to $140,000 a year range. So that would catch a lot of people. And we did mention in the main episode that tax deferral can actually cut both ways. And this gets this idea of a too big RRSP. You're deferring tax to the future, but what happens if your future tax rate is higher? Are you hurting yourself by making this big RRSP? So Ben, you'd actually discussed this notion of a too big RRSP in Rational Minder episode 70. Could you give us some of the highlights of that analysis?
Yeah, definitely. That was a lot of fun to do that analysis, and I will talk about it. But I want to say real quick that the your point about controlling the income from a corporation is so good. I just want to reiterate it to make sure that listeners get it. With the RSP, you are forced to convert your RSP into a RIF at age 71 and start making withdrawals at age 72. And people get scared about that because it's something that you have to do. With the corporation, you don't ever have to make withdrawals, except maybe that there's a disposition on death. But during life, you never are forced to take withdrawals unless you need to spend money to live. But by earning investment income inside the corporation and not taking any dividends out as distributions, you're penalizing yourself because your corporation pays tax at the 50.2% rate in Ontario on investment income. And if you don't pay yourself any dividends, there's this big chunk of refundable tax that's just going to sit there. And there's an opportunity cost of doing that. So while you're not forced to take money out of the corporation, you are incurring a significant economic cost by not doing so. And that's just such a good point and so important for people to understand that in one case, you're forced to take money out. In the other case, you're not forced, but you're eating an economic cost if you don't.
Yeah, and no one ever talks about that.
Yeah. No, that's a really, really good and important point because it is super common. It is super common for some people to just say, well, no, we'll leave everything in the corporation because it gives you more flexibility and whatever. But flexibility can come at a cost. Anyway, so in that Rash Reminder episode 70, we did an estimate of how much higher your tax rate would have to be in the future to make the RRSP put you in a worse position than having invested in a taxable account. Taxable investments, as we'll talk about in our next episode, they're going to have tax drag every year and a taxable capital gain in the future. And then we also have to remember that like the TFSA, the taxable investments are made with after-tax dollars. So if we take a $50,000 investment in a taxable investment account, earning a 2% fully taxable income yield plus an unrealized capital gain of 3%, and then we assume that the RRSP also earns a total return of 5%, though in that case, none of it's taxable inside of the RRSP account. The after-tax return on the investment, assuming a 50% tax rate, is 4% per year. But then we also have the unrealized gain to deal with in the future. So after paying tax on the gain, again at 50%, we're left with just under $100,000 after 20 years. Now, to get the same result from the RRSP, so that was the taxable account. To get the same result from the RRSP, we would need to have a future tax rate that is 13.5% higher than the tax rate when we made the contributions. So a 63.5% tax rate. Now that math is going to work slightly differently for lower starting tax rates as the taxable investments get more tax efficient with lower levels of taxable income from other sources. So with those numbers in our example, at a 50% starting tax rate, as long as the future tax rate is not more than 13.5% higher than the current tax rate, the RSP is still going to be better than a taxable account. And then at lower levels of starting income, that number is going to be smaller. I think the big takeaway here is that if you're starting out in a high tax bracket, it would take a lot for an RSP to genuinely get too big, unless it's going to be the one factor that results in OAS clawback. And then even then, I think it's something that could be addressed before it became an issue. So if you realize that an RSP is too big before you start taking your old age security or before you have to convert your RSP to a RIF, you can make some early withdrawals from the RSP.
Yeah, and I mean, that gets into another great point, which we're not going to cover in this episode, but we will later. Is so you can just, if you have multiple pots of money, like an RRSP and a TFSA, a corporation and a taxable account, you have a lot of options about the mix that you take when you're drawing down your money. And if you can plan about what that's going to look like now and then during the years when you have OAS as an issue and then towards death, you can actually change the sequence and the mix that you're drawing from those different accounts, and actually gives you a lot of flexibility to minimize the overall tax bill planning around it. So there's lots of ways to get around that, and even be able to plan and take money for things like a one-off splurge expense, like you buy an RV or a car or cottage or something. So having that flexibility of using multiple accounts is probably a lot better than just having everything in one account, even if it's a corporation. And the other point I would say too with this is, you want to diversify your portfolio, not just against the specific risks of the investments, but also the tax changes that can come with all these different accounts. We've already seen this happen to corporate accounts once, where the tax laws have changed and generally not going to be in a favorable way because very few people have corporations. They're a small part of the voter population, but a lot of people have RRSPs and TFSAs. And if you start touching that politically, it's going to be a nightmare. So spreading out your wealth rather than just having it concentrated in one account probably has a benefit on its own, in addition to the fact that you'd really have to have a much higher tax rate in the future for the RRSP not to be beneficial to you.
Oh, yeah. The bucket diversification, if we can call it that, is such an important point too, because we've seen the changes in how passive income rules affect the taxation of corporate active income. That was not always a thing. And if you were someone who had not used your RSP or your TFSA and you had all of your savings inside of your corporation, that puts you at somewhat of a disadvantage relative to somebody who had been using their registered accounts, because that increased your passive income relative to the alternative scenario. So yeah, that's a great example there of how legislation can, boom, at the snap of a finger, make a concentrated strategy, where concentrated means all of your assets in one bucket, can make it suboptimal really quickly.
Yeah.
Cool.
Great.
All right.
Yeah, we covered lots of territory with those cases, and thanks for joining us, and hopefully you'll join us again for our next episode that we've got coming up.
Yep. So this is our case conference for episode 8, and we will see you in our next episode 9 on the basics or not so basics of investment taxation.
Yeah, the basics and plus.
Yeah, basics plus. All right.